Investing with a plan gives purpose to your portfolio. Hi, my name is Freeman Linde. I'm a certified financial planner and an enrolled agent with the IRS, which makes me a tax expert, and I help folks just like you every day retire successfully and stay successfully retired. Right in the middle here of a series on creating a financial plan. Right? I'm a financial planner. You should have a financial plan. Everyone should have some kind of plan to achieve what they want to do. And for many of you, you may be a DIYer, you're trying to do it yourself. And so how do you create a financial plan? And so we are walking through how to do that systematically. So we're a couple episodes into it. If you missed those, go back and view those ones first. But we are starting with, as we actually get into all the elements of planning, we're going to start with investment planning. That's right. Investment planning is one of the crucial parts of financial planning. Investing is not the plan. Investing funds the plan, right? Your portfolio is not the plan. It actually funds the plan. And so today we are going to look at creating an investment plan and look at seven different steps that you can go through so that you are actually investing with purpose. Now, again, we want to do investment planning near the beginning of your financial planning process, not at the end. There are some financial planners who like to kind of downplay investing, put it towards the end. Hey, we like to focus on everything, not just your investments. And I think that's wrong. And here's why. Your investments are going to do things in the background, right? So we attack investment planning first, not because it's necessarily the most important thing, but because it does still work while you're doing things. So if it's going to take us a while to figure out tax planning, or you got to wait till the end of the year to figure out what your income is and know what your conversions are going to be, this, that, and the other thing, right? Okay, but your investments are still going to be doing things between now and then. And so it makes sense to attack those early and make sure that they are invested according to a plan while we're doing everything else, right? And so in that way, we want to get right on them. And also, your investment strategy shapes a lot of your other decisions, right? When you claim Social Security is heavily dependent on what you're doing for investments, right? When you can retire in the first place, it's heavily dependent on what you're doing for investments. Your tax strategy, how much Roth conversions you're doing, all this depends on your investment plan. And so we'll want that at the beginning so that we can shape all these other aspects of the plan. Now, again, before we actually create a plan, we have to figure out what is the actual purpose of investing, right? Your investing is here to fund your goals. It's not just to say that so you can brag about how much you have in investment. So what are you actually investing for, right? For most people, at least some of your investing is going to be for retirement. Hey, at some point, I don't want to work anymore. And I want my money to earn more than I do, right? I want my money to be working harder for me than I've been working for it. And so how do we invest for retirement so we can no longer earn our money, instead our money earns our money, right? Maybe you're investing for specific major purchase, right? A home, a vacation property, whatever else. Maybe you're investing for education, either for yourself, a child or grandchild, right? So then it's a different time horizon, a different goal than retirement. Or maybe you're like, hey, I'm not going to use all this, and I want to make sure that even after I go, that there's some left over for my kids and grandkids, and you're investing for legacy. And so depending on what it is, right, you need to make sure that we have an actual reason why we're investing. Is it just to throw money into accounts because we said we should? I don't think so. We need more of a purpose than that. So again, your portfolio is not the plan. Your portfolio funds the plan. So we want to make sure that we have that. So as we look at investing and how do we do this, we want to look at what are the drivers of long-term investor success. And I want to take real quick before we jump into what those drivers are, what do we mean by this? And I want to take each of these words backwards, right? What do we mean by success? Well, again, success is actually achieving your goals, right? That's what true investing success is. It's not outperforming the market or paying the least amount of fees or any of these other nonsense. Because if you do all that, right, if for 3 decades you slightly outperform the market and you pay the least amount of fees and you still ran out of money, was it a success? I don't think so. And so real success is measured by, did you achieve your goals? Did you do the things that you wanted to do? And did your money help you do that? Did your investments fund that? Investor success, right? We can't control what our investments do. We can only control what we do as investors, right? I've talked about this before and I'll probably talk about it again, right? I care way more about investor returns than investment returns, right? Because those we can't control. We can only control what we do. So we really want to focus on that. We also want to focus on long term, right? We're not worried about how do we be successful investors this week or this quarter or even this year. It's over the course of our lifetime, how do we drive long-term success? And then drivers, right? What can we actually do to increase the likelihood that we succeed over the long term as investors. Right? So what are these drivers? What are the things that mostly contribute to that success? Okay, so if you had, hey, if all the drivers that attribute to success, right, the vast majority of it is going to be your behavior, right? Again, going back to investor success, what you actually do, right? Your savings rate, how much you're actually putting away, the way you control your lifestyle, how much you are spending, and how you are spending that money, getting invested, staying invested, doing the conversions, doing the tax planning, creating your financial plan. All the things that you can actually do is going to have the biggest impact on your success. And sometimes it's easiest known by what happens if you have the wrong behavior. Right? Again, if you're invested really well, you're riding all the ups and downs of the market for 30 years, then you retire, woohoo, and we're like, hey, we're there, and then the market goes down by 35%, and you decide to pull out, and then it goes up without you, and then you eventually reinvest in, and the market keeps going up, but now you're this far behind. That chunk there that you lost out on by panicking out of the market just once was way more important than all the other things, anything else in this category that you could have done to be successful, right? And so it magnified the importance of what you did. And so sometimes doing the wrong thing, and so avoiding doing the wrong thing is often just as important as doing the right thing. And the things that we actually do matter more than anything else with investing, absolutely. And the good news is this is completely under our control. The economy's not. The global politics is not. There's a lot of things that are not in our control, right? But our behavior is. And so that's the good news, right? The bad news is that we have to control ourselves. The good news is that we can. And so above anything else, right, everything else pales in comparison to how important your behavior is and how you act, not just this year, not just this week, but over the course of your entire life, right? And so if everything else is going to fall apart if you don't behave right, and everything else is going to be magnified if you do behave correctly. Okay, so if we then zoom in, hey, let's zoom in on this everything else. What is that? Okay, well, then beyond that, if you zoom in on that, most of everything else that's going to be important is your asset allocation, right? And that's the difference between, hey, what do I have in fixed income, right? And I can't do colors on this particular program, otherwise I would make this blue. And what do we have in equities, right? In stocks, in the best businesses in the world. Right? And your combination of how much you have here versus how much you have here is going to drive most of your performance. Right? Not what exact stock you picked or when you got in the market or in and out, all these different things, right? Whether you bought low on this one or sold high and all these, what the alpha is and the fees and all these things. It's how much did you have in equities, riding the roller coaster? How much did you have in fixed income over what amount of time? Right? That's going to drive the next biggest chunk of your success is going to be in that asset allocation. We've talked about it before. We haven't talked about red bucket, blue bucket. So you can go watch some additional videos on that. Okay, let's zoom in on, hey, so then what's everything else, right? So this, right, it's just a tiny bit way up here. What are they going to? Real quick, back on to the asset allocation. Would you rather, if you were investing or betting on a race, would you rather bet on horses or hippos? Right now, hippos are actually pretty fast. Go find some YouTube videos on hippos charging. It's pretty scary. They can actually move pretty quick, but not for very long, right? And obviously, horses can run for a very long time, and they might get tired. They might go the wrong way, but they are going to be the better bet long term. So if you had to guess between fixed income and equities, what's going to be the better long-term winner of the race of investing? We know this one's going to outperform long term. And so it's just a matter of having a good investing plan that mixes these two together if you're close to or in retirement. And if you're not close to or in retirement, do you even need this? I'm not allowed to say. I'm not allowed to give you investment advice over a YouTube video, but something to think about. Okay, zooming in on this everything else. Then we have taxes, right? What you actually pay on those things, and some of it's like Roth versus traditional, and that's tax planning. That's a whole nother set of things. But some of it's just like the taxes that you pay inside of account, like having that great right. You have asset allocation, and then there's asset location, which is having the right types of investments in the right types of accounts. But more than a lot of these other things, taxes really do matter, and that's why we spend so much time on tax planning, because that can make or break the difference between not usually just retiring or not retiring, but how much you're able to spend, how much you're able to leave, how much goes to the people you love. Taxes are going to be a big one, right? Diversification, that's how are you invested, right? So if you got your equity bucket, how is that broken up, right? We had our horses. Now, which horses, we are betting on horses. Which horses are we betting on? We'll bet on all of them, bet on some of them, not just one, right? So how you're diversified is going to be important. Fees are important, not as important as people think, right? There's some people that they're hyper-focused on paying the least amount of fees. And it is important, but it's this tiny subsection of this tiny subsection. So it's like, it's like that important in the grand scheme of things, right? So it's not nothing, but it's not everything, right? All things being equal, choose lower fees for sure. Just make sure that when you're doing that actually everything else is actually equal, and you're not just assuming they are and just going for the lowest fee option, right? And then the actual funds you pick, when you get into it, timing, all that other stuff, right? Minuscule amount of your actual success. And you can't control hardly any of this stuff, and you don't know which selection is going to be the best. And so yes, look for fees, make sure you're diversified, make sure, right? I would rather have someone with better tax planning invested just in one fund, just like in the S&P 500 or total stock market fund, that you'd be better off with proper tax planning and one fund than being diversified. So taxes are more important in my opinion than diversification. Some people might be shocked by that, but it's true. And then, but all those are more important than fees, which is more important than everything else. And none of that's near as important as behavior. Okay. So how do we actually create an investing plan then that helps us do this? So here's 7 steps for it. 1, we want to adopt a planning mindset. We got to commit to a long-term strategy, not short-term reactions, right? We can't just be constantly looking at what the market's doing and then jumping in and out, trying to choose hot funds, looking for hot stock tips, whatever else. We need a strategy that we commit to and a mindset that says, hey, we're invested for the long term. We are business owners of the best business of the world. And like good business owners, we're not constantly buying and selling businesses. We buy good businesses, we hold them forever. And part of that is just building your knowledge, right? Knowledge builds confidence, and confidence builds discipline. I'm glad you're here. You're building knowledge right now by learning some of these things. So that's great. So mindset is key. If you don't have the right mindset, again, it's going to blow your behavior, and then nothing else is going to matter. So step 2, define your purpose. Hey, what are we actually investing for? Each account that we have needs a clearly defined goal. This means a dollar-specific, date-specific amount that we need in there, right? So not just like, oh, I'm saving nebulously for retirement. Part of your plan is you would say, hey, I need $2 million by age 65 for retirement, right? It's for retirement. That's what we're doing it for. I want $2 million and I want it by this time, right? So part of the overall planning process would be to say, hey, how much do we need to live on? And at what point would we want that by? And then therefore we need that amount in these types of accounts in order to achieve that, right? If it's for education, hey, we're trying to save X amount by this year for this education in these types of accounts. So we really need to know why we are investing. Okay, step 3 would be determine your asset allocation. Again, right, your mix of equities, best business in the world, and fixed income should match your timeline and goals, right? The longer your timeline, the more you could have in equities. I would personally advocate for way more than most people think. But again, I'm not allowed to give you exact investment advice over a video. So, right, how much you're going to have in there? What do we want in fixed income? What do we want in equities? That's going to determine so much of your lifetime success that you really need to understand that. I've got a whole book. Got to have it handy here, right? This whole 3 retirement income book. We'll do this one. There we go. Would help with that one. Okay. Yep. Wrong one. There we go. All right. Step 4, build your diversification strategy. You want to, so of your equities, right, what are you going to own inside of there? And you would want to own different investments that complement each other, right? Whether it's by size or sector or whatever else that, yes, equities in general, like when the market goes down, everything goes down, right? But they don't all go down at the same time, right? So hey, market goes down, but some are going down like this. Maybe one's actually not going down that much, but everything else is. But the differences between here and 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 here create other opportunities to have to increase the chance of achieving your goals, right? So you want to, but if it's all invested in one thing, you only have one. If it's in a bunch of things, you have options, right? And options are really important, especially in retirement, right? And you obviously want to reduce any unnecessary risk while keeping it simple enough to stick with, right? So we want enough things in there so that we are not all having all of our eggs in one basket, but we also don't want 86 securities, right? We don't need 17 different funds because you're not going to stick with that. If you don't understand it, you're not going to stick with it. It's kind of like the best diet is the one that you actually stick to. The same way, the best investing plan is the one you actually stick to. And so what is your diversification strategy? There's a balance somewhere in there between complex and simplistic, right? Which is elegantly simple, I think is what we'd go for there. And then we would want to create a rebalancing plan, right? So we have all that stuff. When are we going to rebalance? So the markets are constantly shifting, right? And so you want to, and they'll shift what your intended allocation is. So we want to rebalance on a specific schedule, right? And so again, they might, you got two different things and one's kind of going like this and one's kind of going like this. Well, this one might teeter back out and this one might go up, right? Because in general, they both long-term are doing very well. Well, if this one's way above schedule and this one's slightly below, then this one might correct to adjust to it and this one might go up. So do you sell a little bit high here and rebalance that into the other one so that it brings them closer together? And if you do that enough times, it should increase your overall portfolio. And so most people, right, they're maybe you're going to rebalance quarterly, maybe annually. The best time would be during a very specific time, right? You're really paying attention to it and you're just, nail that target right in the middle of the best time to rebalance. That requires a lot of attention. We obviously do that because that is the best time to rebalance when the situation arises. But minimally, you'd want to do quarterly or annually. And you want to stick to a predetermined plan, right? You're not using emotional reactions to the market. You're not looking at the news and having that decide what is going on with you. You want to have a plan for when you're going to rebalance these. And then we want to, of course, optimize for taxes and costs, right? Using the right types of accounts. Again, we'll get way more into this in tax planning, right? We don't want to have a whole bunch of unnecessary trades that just generate additional taxes. And the goal, of course, with the fees isn't to have the cheapest investments, it's to have the most effective plan. So again, way too many people are way too focused. Some people are not focused enough on fees. Some people are way too focused on fees, and it's all they care about. And again, all things being equal, choose lower fees. But effectiveness is more important than cheapness, right? It's kind of like I was having a conversation with someone the other day, and they were talking about how they're getting close to retirement. So we were just talking. They were trying to decide if they wanted to meet with us or whatnot, and he was just going on and on about like how they were debt free and they hadn't saved really that much for retirement, but they were debt free and that was a really good thing. And they're raising their kids and their kids are about to leave the nest but they're debt free or they're getting debt free and he's just going on and on about being debt free. And that's great. But people who are homeless are also, a lot of them are debt free, but they don't have any assets, any money, right? There's nothing wrong with being that as a person. But in terms of total net worth, in terms of your ability to actually do things, being debt-free is a means to an end, not the end in and of itself, right? And so having low-cost investments is a means to an end. It's a means to better returns. It's not the end in and of itself, right? Cash has zero fees at all. You put all your money in cash and you'd pay no fees. Okay, that's not the point, right? The point is to have your money working hard for you, and so just keep things in their proper place. It's part of the equation. It's not the full thing, right? And again, we use mostly low fee investments, but don't let the tail wag the dog on that one. Same thing with taxes. Some people are way too focused on minimizing taxes and not focused enough on maximizing the amount after taxes. We've talked about that before. We'll talk about it again. And lastly, stick with the plan, right? When you have that plan, you've got your investment plan, you've created your portfolio, it's there for a purpose, you know exactly what that is, you know what the goals are, you're funding according to that purpose, you actually have to stick with it. Nope, got to put this back up there. There we go. And so back to the behavior, right? You can have a perfect plan, and if you abandon it immediately when times are tough, it's not going to matter, right? It's consistency, not being able to predict the market, that's going to build wealth over time. It's time in the market, not timing the market, that's going to ultimately lead to this wealth. So you need to build an investment plan that actually fits your life, right? It should be goal-driven, right? Where every decision ties back to a specific measurable goal. You also want it to be tax smart, where it's integrated entirely with your retirement income and estate planning for maximum efficiency. You just need all that to connect together. And if you need help doing that, then you would be, always get your advice from a fee-only fiduciary who's not just selling you products, right? So if this all is helpful, there will be more, well, in the coming weeks here, we'll have more videos on creating more parts of your financial plan, each different section. And so subscribe to the channel if you want to see that. If you want help with this, you're like, oh, that seems like a lot of work. Yeah, it is. Yeah, so we're happy to do it for you if you'd like. Otherwise, subscribe for sure, and we'll keep walking you along how to create this for yourself. But those are the 7 steps. Again, we'll just recap those really fast. It's going to have all my writing on here. So have that planning mindset, right? Define what it's for. Determine your asset allocation. Build your diversification strategy. How are you diversifying inside of each of those different types of asset classes? And then when are you going to rebalance? How often and exactly when? Make sure that that's implemented. You have some plan. Like, don't just plan to rebalance it. Like, either have it automated or reminders to actually go do it or whatever else. Make sure that you're optimized then for taxes and costs. Again, not necessarily just minimizing those things, optimizing for them, and then stick with the plan. Make a plan, stick with the plan, and if you need help, we're here to help. Otherwise, we'll see you in the next video. Cheers.